All right, welcome back, traders. John Caruso here for the afternoon of July 13th. Quick look at it on the market. Obviously, we did see the hot reading of CPI 9.1% come out. It was up 1.3 on a month-over-month basis. Question everyone's asking themselves right now is, was that the peak of inflation? Certainly getting a reaction in the bond market suggesting that it could possibly be the peak. We've mentioned in recent videos here that the greater than 20% crashes we've seen in a lot of these commodity markets has yet to be priced into the CPI index. So we will see that actually get priced in the August readout of CPI. So 9.1, that very well could be the hottest reading that we see. So market reaction, the knee-jerk reaction was down in everything. We saw crude oil sell off into the 93 handle. Gasoline prices fell into the teens, I believe, down along 315 on RBOB gasoline. Copper prices were hanging around the low 320s for the better part of the morning. Of course, we did see the bond market react initially down, and then we saw down and then up as we saw yields pop and then drop on the 10-year yield. 291 is the 10-year right now. We've got an inverted yield curve of minus 22 basis points. So if you take a look at what's going on with the yield curve, obviously a classic harbinger for an oncoming recession. We know the Fed is going to remain tight. Obviously, the CPI number is going to keep the Fed on a hawkish tilt, looking for 75 basis points at the Fed meeting. But the compression that we've seen in the yield curve, or the inversion, I should say, of minus 22 basis points, that's telling you that the Fed is likely tightening head on into an oncoming recession, and the bond market is telling you that they don't like that. So that's coming out in the form of the inverted yield curve, as we mentioned, minus 22 basis points. Also, beware of the narrative that could be coming down the pipe here, and that is that because commodity prices have fallen, we've seen gas prices come off, oil prices, food prices, everything come off, that it's okay to start buying stocks because inflation is going to begin abating. You want to be very careful on that. The reason why we're seeing commodity prices come off so strong is because they're pricing in demand destruction from a possible oncoming recession. So you want to be very careful. I don't think now is the time to be getting long of the U.S. equity futures at present levels. Sure, we can put together a multi-day rally, but I do think ultimately those rallies will fail, and I think there's a ton of risk coming out into the fall for the equity space. So best of luck to everybody out there. We'll catch you back here in the morning.